One of the big economic debates this year has been, are we in recession? The debate has hinged on the wobbly GDP while its lesser-known twin GDI is screaming red. The U.S. government uses two main measures of economic growth, GDP and GDI. GDP, gross domestic product, measures production, all the stuff we produce in a year, while GDI, gross domestic investment, measures all the income we receive in a year. In theory, these should be equal since they're two sides of the same transaction. So you produce something, you sell it, and the price should record on both sides. In fact, the Bureau of Economic Analysis, which calculates both GDP and GDI, calls them conceptually equal. The problem is that since the pandemic, they have diverged massively, with GDI lagging by about $240 billion per year. That is a lot of lost activity for conceptually equal. In fact, $240 billion is the GDP of Ohio. More important, if GDI is the true number, it implies economic growth could be overstated by almost 3%. This matters because the entire recession debate has hinged on GDP's bouncing in and out of negative territory. If, in fact, GDI is the more accurate, then we've actually been shrinking for 18 months now. The last time we saw a streak that long was Q3 of 2008. That was the eve of the Lehman Brothers collapse that set off the great financial crisis. Now, it's worth noting that even the GDP numbers are no great shake. It's standard for GDP to wobble between positive and negative early in any recession. For example, in the 2008 crisis, which was the worst since the 70s, Q1 was negative, and then Q2 bounced to positive. Then GDP went negative and stayed there until late 2009. The recession, according to the official NBER, was officially set to that very first dip. They ignored the wobble in 2008. So if the 2008 recession was declared after just one negative quarter, we've already had two negative quarters, which is the standard definition for going on 100 years. Meanwhile, if the GDP versus GDI mystery turns out in GDI's favor, in other words, if income is the accurate one, then we would be at 6 negative quarters, but still not an official recession. Now, if policymakers and government statisticians, whose salaries you pay, were actually trying to report the truth about the economy, perhaps to offer needed guidance to businesses, banks, and households, they would take those two negative GDP prints, they would cross-reference the 6 negative GDI reads, remember they're supposed to be twins, and they would sound the alarm. Of course, their goal is not to responsibly guide us, it's to gaslight us in hopes we overspend our way out of the crash. I've mentioned in recent videos that this is literally policy, this deception is called forward guidance, and they attack anybody who goes off script and warns Americans to prepare. The bottom line is that GDP says recession, even with the pandemic fog, going by the 100-year definition, while GDI says we are already in deep recession and have been for a long time, with stocks held up by little more than central bank liquidity, all while Washington gaslights Americans into ignoring the speeding train until it hits, at which point they will say nobody could have possibly seen it coming. Okay, we'll be watching. See you next time.